You're watching Economics Amplified, the latest thinking on the biggest issues from UChicago's Becker Friedman Institute.
So I'd like to welcome you today for an additional installment of the Friedman Forum for undergraduates. And as Grace mentioned, this is one of a variety of things which we're doing for undergraduates. We're also working with some of you to put together a kind of public policy forum going forward. There's attempts to recruit Bernanke that have, I guess, stalled out a bit, but we'll try to do something interesting as an alternative. We'll get a Neil to talk or something. I don't know. We'll see. But anyway, I'm very pleased for you to come here. I think it's a great opportunity. I want to thank Dean Boyer and the college for their support of these Friedman Forums, and I'm really pleased to have Richard Blundell here from the University College London. In addition to an old friend. We've been comrades at the Econometric Society for probably too long, I suppose. Richard has been a very distinguished researcher. He's rather unique within economics because what he's very good at doing is kind of looking at economic theoretical models and looking at evidence and seeing how they connect and kind of figuring out when they do connect and when they don't connect. A lot of his work has been devoted towards micro data sets, large-scale micro data sets, and some of the various implications. In addition to his kind of faculty position at the University College London, he's the research director at the Institute for Fiscal Studies, and he's won some very prestigious awards: the Johansson Award for distinguished European economists, the Econometric Society Frisch Medal, the Lafont Prize for his connections between economic theory and empirical evidence. It's interesting that I think that it's my understanding, I could be wrong, that Richard Blundell never received his PhD degree, so he's perhaps underqualified, except for the fact that he does have honorary degrees from many universities. So I think that's I think that gap has now been repaired. So anyway, it's my great privilege to introduce Richard, and I think Richard would like this to be an informal discussion. So you should feel free to interrupt him with questions along the way, ask questions afterwards. I think he'll be happy to entertain them. Thank you.
Thank you, Lars. Great, very nice introduction. It's a pleasure to be here. Feel free to just ask questions. It's supposed to be a forum, so that's fine. What I put together here is a reflection on Mirrlees' review, and I'll tell you a little bit about that, and then what the reflections are. And in particular, it's about the role of empirical evidence. So let me tell you a little bit about the review. The review was published nearly 2 years ago now, and so it's time to reflect on it a little. It was the idea was to take a comprehensive look at the tax reform generally. And as Lars said, the kind of idea behind this whole research program is to look at how the interplay between evidence and theory. And of course, there are many tax reviews out there. There's always a need for them, I guess, because the environment is always changing, and there's always new things to discover. A key idea behind the review was to view the tax system as a whole. That seems pretty obvious, but it isn't really obvious when you look at the way tax design is typically done. Increasingly, tax design is done by looking at little tweaks to particular things, that are carried out in somewhat independently of the way the rest of the tax system functions. And the key idea of the review was to look at the tax system as a whole and take a kind of broad brush look at taxation of savings and capital, earnings, direct taxation, indirect taxation. Indirect taxation is a pretty key area in Europe with the whole debate over VAT. Of course, it's less of a debate here to some extent, but maybe it should be. VAT is a pretty important tax, and it's interesting to note that the US doesn't collect revenue through VAT. So I might comment a little bit on that and corporate taxation. the idea was to look at the linkages through those. And for developed open economies, in fact, really small open economies, the UK is the running experiment. There's a lot of people involved. There were a lot of people involved. Jim Mirrlees, famous for his work on optimal tax, I think not famous for his work on the use of empirical evidence. And so the idea really was to get thinking about how you could use some of the ideas from tax theory in implementation. And then there's a variety of players here, including Jim Paterba, who's director or whatever of the National Bureau of Economic Research, and giving a kind of US perspective on this work. Just a little bit of background, then I'll get into some more detail. There's 2 volumes. This is relatively important because I'm not going to cover very much here, and you might be interested in exploring some of this further. The way the review went was that we set up some kind of evidence first, and there's 13 chapters with commentaries on different aspects of the tax system, from environmental taxes through to taxation of savings, capital, corporate taxation, and what have you. And these are kind of international experts. And one interesting thing relative to just what was announced is we put together international experts together with young researchers, even some being undergraduates, to kind of take a look at what we know already and a look at particular aspects of the tax system. So you've got about 50 different authors commenting on that, including probably most of the top names in tax research. And then after that, there's a book by that group of editors that takes all the volume together and tries to draw something out of it. That's a pretty hard thing to do. You've got lots of disparate ideas, and we didn't put any constraints on the first volume. People could write about whatever they liked. And the Tax by Design book is trying to bring it all together, and that's what I'm going to reflect on a little bit here. So it's an integrated picture of tax design and reform written by the editors. That's all open access at OUP, so feel free to go there, or you can find it all on the IFS Mirrlees Review website, and that's that. So looking at just a little bit of background, when we were setting this up, we started from a structure of taxes and benefits, welfare if you want. Our remit was really looking at taxes and some aspects of welfare. And the first thing we did was to take a take on what we saw, and I think this is a pretty common picture wherever you look in whatever economy. Mostly the tax system doesn't work as a system. There's a lack of joining up between welfare benefits, personal taxes, and corporate taxes. And that causes a lot of unnecessary distortions in a sense. And part of the review's message is to make sure these hang together. And of course, that's not that's an old idea in a way, but there's plenty of new things to say on that. In particular, the links between these 3 things: benefit structure, earned income tax credits, if you want, personal taxes, and then the taxation of assets and capital. There's lots of room for revenue shifting, which is a very inefficient way of tax design. It's not neutral where it should be. Of course, there's nothing particularly optimal about neutrality, i.e. neutrality that tax rates should be effectively similar across different sources of income. But there are places where you'd expect neutrality to operate, in particular in savings taxation across different types of assets, and in corporate taxation with different ways of raising revenue to fund investment. And we know, including in the US, there's a tax system that favors debt over equity, and the taxation of different assets, sources of income from different assets is quite different. And there are aspects of neutrality where it's very difficult to argue there shouldn't be some move towards neutrality there. And I may come back to that as I'm going along. It's not well designed where it should deviate from neutrality. We do a lot of work on how carbon, for example, is taxed differently among different ways of consuming carbon, whether it be in domestic energy, in driving or in business. And you find there's a huge variety of effective tax rates on carbon. And similarly, where you'd expect deviation from neutrality on where you think about one of the biggest externalities, I guess, out there in terms of transport would be congestion charging, and we put a big move towards congestion charging, especially in transport. I might talk a little bit about that, but probably not much. And it doesn't achieve progressivity efficiently. So there's one obvious point is that not all taxes need to be progressive to achieve progressivity overall. And a good example in the kind of European context of that is where you have a VAT system that excludes certain goods, basically on the basis of progressivity. It excludes, say, tax on food or clothing. Those are good examples in the UK, for example. And we argue that there are ways of reorganizing the tax system which would make things much more efficient by broadening the base of VAT and not wishing to make every tax, if you went, progressive. And I'll talk a little bit about that, I guess. What I want to do, though, in this talk is not go through every detail of that, but to give a bit of substance to the aspect of the review, which was the role of empirical evidence. And in fact, I've subsequently written a paper on exactly this topic. It's a little more technical than I'm going to talk about here, but it's on the website if you want it. And in thinking about this, how do we use evidence? I came up with 5 steps, and you can debate these. But I guess the first step is just looking through where are the key margins of adjustment to tax reform. So as you look around, where is it that it looks like taxes are having an impact? There's nothing about causality here. That's going to come later. But it's just looking in the data for things that really matter. And if if there's really little evidence of adjustment or differences across actions which are taxed very differently, then it's very unlikely that there's going to be much in the sense of behavioral elasticity there. And if there's very little adjustment to tax reform or different taxes, then that gives you that's very informative in thinking about tax design. We're particularly interested where responses are likely to be largest. Of course, the next thing to look at is exactly what is the effective tax rate. So how do we think about measuring effective tax rates? What does the tax wedge look like? How does taxes affect what is the incentive? What does it look like? And you very quickly realize that's not such an easy thing. If you take the interaction between the benefit system, the direct tax system, and the corporate tax system or savings taxation, working out the effective tax rate on, say, consumption, for example, or an extra dollar of earnings it requires a little bit of thought. And that's going to be important, and I'll come to exactly how that works. A lot of empirical work on tax reform doesn't really look at this. It kind of says, well, here's a tax reform, this is the reaction, without looking at the exact size of what you might call the treatment, exactly what changed and how big was it. Of course, to economists, you typically think of effective tax rates as just putting all the tax rates together. Maybe there's a tax rate on employers, there's a tax rate on employees, and we think of bringing all those together and getting a single tax wedge. But maybe things are more difficult than that. Maybe people don't see those different taxes in exactly the same way. To some extent, that's about information. What do they understand is the tax system? What do they think is affecting? What is affecting their, say, take-home pay? And complexity as well. If it's a very complex system, it's difficult to think that people can really get a precise idea of what the effective tax rate is when they're making their decisions. This is a difficult area, really. It's a difficult area for tax design, But in the end, in this review, we kind of came up with the idea that, in a sense, the tax system should be as transparent as possible. There is another view that it's good to make the tax system complex and non-transparent and confuse people. You can even effectively raise more revenue, potentially at less distortion with that. And there's a debate in the behavioral economics literature, in fact, on exactly that. But we felt that, in a sense, when you're designing a tax system, you want people to understand it, and complexity, you want to, therefore, reduce complexity as much as possible. I'll come a little bit back to those kinds of debates. Then after that, you're getting more down to the econometrics of or the causal analysis of the empirical analysis, if you want, because you've thought about where margins are likely to be important. You've put together some idea of what the effective tax rates are. You've got some idea of how people perceive those tax rates, and then you want to see how they responded in a causal sense. You want to look at their behavioral elasticities. And I'll spend a little bit of time talking about them, because there's a number of approaches you could take here. For the design of taxation, it's pretty hard to do this in any way other than try and write down a pretty structural or a theoretically based model. And I'll show you how that works in one particular case. And in fact, at that point, although in some sense the theory's been working through all of these aspects, theory comes in good and proper at this point, because you want to think about, well, how should I design the tax system in an optimal sense? Of course, there's a normative side to this. It depends on how you value incomes going to different types of people, and how you value equality, for example. But nonetheless, you can draw some quite general and reasonably strong conclusions for reasonably general social welfare functions. And that's the kind of structure of the Mirrlees model, and I'll talk a little bit about that. Okay, here in the little time I've got, I'm going to focus on earnings taxation, and maybe a little bit on the interaction with consumption and saving and capital at the end if I get time, but I probably won't. I'm happy to talk about it. So what about new evidence? What kind of evidence are we thinking of here? Well, if you're thinking of just of work on the labour market and how people respond to taxes and welfare, there are kind of two features of, at least two features of kind of modern empirical results. One is that the distinction between the intensive and extensive margin matters. That's whether you're in work or in a particular occupation versus how much you do in that occupation or in work. So the intensive versus extensive margin. That has a big effect on the optimal design. And if you look back to the original Mirrlees paper, which won him the Nobel Prize, there's no distinction there. There's just an intensive margin, in fact. And that has a strong implication, as you'll see. Yeah. A question.
I understand what you mean by intensive.
Yeah.
Intensive and extensive have a time dimension, so when taxes are collected on a yearly basis,
yeah.
unemployment benefits are done weekly.
Yeah.
I'm not sure what you mean.
Yeah, all good points. Typically, we're thinking of a kind of annual basis, but you're right. So I'll come down to that a little bit. Let's imagine that if you're thinking of design, let's think about earned income tax credit, which I'll come back to. It's an important question, because the way it's the kind of period. The period that is used in the UK is different to the period used in the US, for example. But let's think about the idea you've got individuals who are deciding whether to work or not, to be employed or not over that period, let's say the tax year, and then conditional on work, whether on how much they supply of that work. And we're thinking that there may be differences in that margin. So it may be that there are fixed costs of work or something like that that make the responses different.
Yeah. I mean, Julius Caesar invented the calendar, but
yeah.
I know you're thinking about models with behavior. I don't quite see how you make the connection between Julius Caesar's calendar and people's decisions.
Yeah. In all of these models, you do have to put some period of decision into when you're modeling behavior. And so if you think about employment, let's imagine, let me take an example, employment and hours are decisions of single mothers. That's a kind of very important design problem for EITC or welfare benefits. And you're thinking that there's one aspect, do I take a job or not? And then how many hours do I work in that job? Do I take a job or not? We're going to be thinking of that over some period, perhaps a year. It's not clear. I mean, that's an important point here. To the extent where I'm kind of almost with you here, because in the literature on tax design, there's been a huge move to emphasizing the extensive margin. And as you'll see almost on the next slide, I say that's probably too much. You have to be a little careful there. Because if you emphasize the extensive margin too much, you put all the weight on the average tax rate and the incentive to get people into the market. And you can load up the marginal tax rates when they're in the market. And it's that balance that's important. But I agree, the periodicity of taxation and how you do that's important. Taxable income elasticities, that's another thing we know about, or at least we have more information about, and that's really looking at how tax revenue responds as tax rates change, and again, typically on a year-by-year basis, but we'll look a little bit about at the periodicity of that as well. Why has that been particularly, where's the information come there? Well, we have access to a huge amount of tax return data now that we never used to have, and we can do a reasonably good job of trying to pin down some idea at least of how changing tax rates affects tax revenue, and that's going to be quite a key parameter, at least for some tax design problems. When it comes to I won't spend too much time on this, but if you're thinking of VAT or indirect tax design, then you also need to know how consumers respond at that margin. And then there's intertemporal behavior, not unrelated to the question as well. So you're thinking of period by period savings, consumption, investment, savings in one period for future for future consumption, and we have a lot more information on how people behave there, although I still think that's probably the weakest side of where our empirical knowledge is. And of course, there's a huge interest there. The exact persistence and magnitude of things that hit individuals over their life cycle. When you're thinking about intertemporal behavior, then you think of the insurance value of taxation, not just its redistribution. It provides insurance to you or to individuals, and therefore you need to know somewhat about the uncertainty in their lifetime incomes before you can kind of comment on how important that is. And all these things we have quite a bit of new evidence for. Taxation of earnings is a nice one to focus on, just to give you an idea, because of lots of evidence on intensive and extensive margins. It's got key implications for tax design, and if you're thinking about in a reasonable framework, I think, you want to do most of your redistribution through the direct tax system and not through other aspects. For example, in general, it's probably better to do redistribution through the direct tax system than the indirect tax system. So you're better off, for example, rather than excluding some particular set range of goods like food from the indirect tax system, you're better having a uniform rate or a close to uniform rate there and doing your redistribution more directly through the direct tax system, and that's going to be important here. This, of course, in doing this work, there's the review, by the way, is supposed to be accessible to undergraduate and undergraduate economists and economists working in kind of policy fields generally. And so while we were doing this work, of course, there's lots of technical work to be done, and there's a few papers here that I'm going to refer to. I will have hardly any time to do that, but there's some more technical work that backs this up. And indeed, I'm giving a talk later on the human capital side of taxation, and that's in the final paper here. Why is this important? Well, understanding responses to tax and welfare reform, there's a lot of previous empirical work from the micro to macro and public policy community that have always pointed out that this is an important margin. So Jim Heckman, of course, is famous for his work on the selection model. The selection model is takes a stand on the employment decision versus the what you do when you're in work, how many hours you supply. And the whole point of the selection model is that there are reasons why movements into work are different, reflect a different kind of decision, or face different costs, if you want, to movements in work. And then therefore, labour supply elasticity is going to be different across those two margins. Gruber and Wise, when talking about retirement incentives, point out that the extensive margin at retirement is a very important one. And of course, Rogerson, Prescott, and that macroeconomics group have pointed out that the extensive margin when you're in work at particular points of your life cycle are key in understanding how variation in labour supply. Sorry?
None of them had a calendar year time frame.
Yeah, they do. Yeah. Let me come back to that. I'll argue it can be given too much weight. But the size matters. If you're thinking of designing a tax system, people choosing to be into work or not, and then how many hours of work they're going to make in that system, that's a decision you can think of, and you then have to place it in some kind of time frame. If there are differences there, then if there are differences in those margins, then that's going to be important on how you think about designing taxes. And that's we use pretty heavily in the review. Sorry.
So can I push you to give some magnitudes of the order of the difference in terms of the margin tax?
Yeah, I'm going to talk about that. So give me a bit of time there. Let me just talk about the kind of evidence then. So when you look at the extensive margin, employment or not, in a particular year, this is exactly the same kind of graphs figures that you would find in, for example, Rogerson's work, and it certainly took us. It had a big effect, in fact, in the review when we looked at this kind of evidence. This is across 3 countries that have very different tax rates on employment. This is male employment by age in a particular year. And this is using, for example, the CPS and the labour force surveys in these 3 countries. And you can see, so we've got France, the UK, and the US. I'm looking at 2007 because it's a kind of buoyant period in the economy. So we're not really thinking of tax design here for deep recession periods. We're thinking of a kind of long-term structure of taxation. And so we looked, in fact, across a whole slew of data, but picking on relatively buoyant periods. And you can see that, perhaps surprisingly, the US, France, and the UK, the employment rates for men in that age group from 28 to the early 50s is almost indistinguishable. And they clearly, as I show you, face quite different tax rates. So the chances of getting any big responses on tax rates on employment for this particular group are going to be low. But you can see at either end of the life cycle, there's a chance for some action, because there's big differences here, and we'll look at different education groups and other groups. But this gives you a good idea of what's happening. Of course, we can't say from this that it's all the tax system or the pension incentive system or education system that's driving these, but you can see where there really are key margins of action at the 2 ends of the lifetime. And but if you look at hours of work, let's just take that as the intensive margin, hours over the year, you can see a very different picture. The US dominates pretty much across the whole lifetime. So there's much longer hours of work generally than in the UK, and much more than in France. And this just gives you an aspect of why the intensive margin could be important. There's a lot of action here, in fact. We know that the hours supplied in the US is much, much higher. And we also know that the tax rates work in pretty much exactly this order. So there's potential for some action here from taxes on the intensive margin. And you've got to take a good idea on the balance of this here. Of course, it wasn't always like this, by the way. If you go back to 1977, the UK dominated completely in terms of hours of work. So there's movements across time and across countries here that are useful to look at. For women, if you go back a while, say 1977, for example, there was the famous, especially in the UK, by the way, a kind of dip among the women in the kind of fertility period, if you want to call it that, 26-year-old up to early 30s, and then back in employment, often never quite as high as they were before. And you can see some of that going on in the US and France. But if you look in more recent data, there's not much action there on employment either. So on average, employment rates look very similar. And again, that's kind of, this is the kind of first step, you know, what evidence do we see? And then if you look at total hours, though, there's, again, some action here. So you wouldn't want to, at least on the face of it, load everything onto the extensive margin, whether in work or not, given this kind of picture. There's a lot of action in hours worked over the year as well for these across these countries. And so there's room for taxes to have an effect on both margins, and in particular the intensive margin here. So why is this distinction important for tax design? Well, if you look at the kind of some of the recent tax design theory, applied theory, the Sayers paper, and Laroque's Econometrica presidential address, they emphasize this difference quite a bit and point out that a large extensive elasticity at low earnings can turn around the impact of decline in social welfare weights. So the idea is that even if you would like to redistribute to those on lower incomes, lower earnings therefore, if the extensive elasticity is sufficiently big, then that can flip around the usual Mirrlees kind of result and imply a higher optimal transfer to low earnings worker than to those out of work. In other words, you can even get it going as far, well, that would be an example, where you had a negative marginal tax rate. So a subsidy, optimal subsidy, like you would find in the earned income tax credit potentially. And that of course is impossible in the standard Mirrlees framework. In the original Mirrlees framework, then you would never get, it's never optimal to have a negative marginal tax rate. So one aspect here is balancing these two things. You can see that you might find that there's a role for tax credits in a redesigned earnings tax system. If elasticities differ by people, by types of people, and for example ages, you might, or by groups, then it may be optimal to tag taxes according to some exogenous factors like age. It may be a good idea to have tax credits operating among the young, among those coming up to retirement, so tagging by age or tagging by demographic characteristics. In the review, all we did on tagging, because it's a very controversial area, is we kind of used whatever was in the British system we have, and European systems generally, there's the tax system, when you include tax credits, is conditioned on age and numbers and age of children. And we said, well, let's think about that. Is there a way of exploiting that more efficiently? And do you want to tag by those kinds of things? So if you get behavior differing by those, then there's room for that. Of course, it then you come back to this idea, well, that's you have to worry about how people perceive taxes on earnings and the implicit taxes in the benefit system. So what's the salience of taxes? This is pretty important, actually, when you come to tax credits, where people have to apply to get a tax credit, for example, is does everyone who's eligible apply for that kind of tax credit? And that's an important aspect here. Then there's the importance of other margins other than just labour supply and hours of work. Taxable income elasticities are a good example of that. So there you're looking not just at hours and employment, but you're looking at actual earnings as well. There's importance of human capital, dynamics of frictions. I'll come back properly to that. One thing, just to kind of come back to your question, I think this is moving on to effective tax rates. They can be quite stunningly high for certain groups, and I'll just give you some examples. So in the UK, for example, if you put taxes and benefits together, you can get marginal tax rates as well over 80%, which is a high number, and it's difficult. It may be difficult to argue that's an optimal structure, and I'll give you an example of how that works. So in the review, we put a lot of effort into getting an accurate view of what the tax and benefit system looks like for different margins. This would be hours worked per week, okay? And indeed, in the British system, there are incentives on that are targeted to how many hours you work per week. And that's very related to, do people make their decisions by weeks, by months, by year? Exactly how does it work? And in a sense, you kind of have to combine, you really have to match up how you're working with the tax system and what the elasticities look like at those margins. And I'll come back to, so it's very relevant here. The British system actually has, it's very typical of a kind of welfare system where this would be a lone parent who, when she's not working at all, gets quite a big transfer out of work, and then it's taxed away at 100%. And then there's this big jump at part-time work, which is the tax credit system. In the UK, you get earned income tax credit if you take a part-time job. Jump straight up. And you can see why that was introduced. That looks quite attractive, because otherwise this person would have almost flat incentives right out to full-time work. And these guys would never be in work. If you wanted to provide an incentive for in work, if there was some logic behind that along the lines I said, this might look reasonable. Of course, if you put the tax system together with all the other benefits, it doesn't look anywhere near as you get back to a pretty flat system. And that's because housing benefits, for example, interact with tax credits in the UK, and they do in many economies. If you put all the system together and you believe people understand this budget constraint, that's the salience point, then you get a very flat tax rate. And indeed, if you look at the effective marginal tax rates are going right back to employer costs across the employer cost distribution for different family types, that's where even on average you can get very, very high tax rates. And the question we asked is, does that look like an optimal design to have such high tax rates there? It could be, of course, if elasticities were very low and you had a strong redistributive motive. But elasticity is going to be quite important here, actually, and you'll see how that works. These two high ones are very, it's quite clear why they're there. These are the two groups with families with basically either single mothers or a working couple where only one is working and they have children. And it's those where the tax credit and welfare system redistributes, either through something like AFDC or TANF or earned income tax credits, and you get the high effective marginal tax rates. You get a similar thing on participation tax rates. That's looking at whether you work or not in the week. How does the effective participation tax rate work? More like an average tax rate. And I won't spend too much time on that, but it's a key thing to kind of work these out. I was, in fact, in a sense, if you're looking at a reform to, if you're trying to figure out what is the behavioral response to taxes, a lot of the kind of quasi-experimental work, especially on EITC, just looks at what the impact of changing of the reform is without looking precisely at what the change in the effective tax rate was. And if you can see that, if I go back to this picture, I could have a reform that moves around the size of the orange block quite a lot, but it actually doesn't do much to the incentives that individuals face. And a key thing in this whole review was to really work out what the incentives were, then to see whether people appeared to react to them, and then to work out elasticities, then look at design. So it's those kind of sequence. Do people respond? Well, here's a margin where it looks like they do respond a bit. This is just survey data on hours per week for these low education loan parents. And the incentives at 16, of course, they're scattered all over the place. But for this group, there's an incentive at 16. This group, there's no incentive at all at part-time work. And you can see some differences here. And so it looks like, this is the next step in a way. Is there any evidence that there's some adjustments? This is more getting close to a kind of quasi-experimental step. And indeed, you can look at when the reform, originally there was an incentive at 24, then it moves to 16. And you can track how the hours of work follow that. And in fact, if you look at the UK hours of work for lone parents, in the late 80s, the incentive was at 30 hours, then it moved to 24, then to 16, and it stayed at 16 ever since. And I've got some other pictures for other groups. This is the group where it matters, and you can really see that there's potential. Doesn't say this is what happened, but there's potential that hours responses are really reacting to the incentives in the tax system. And so we put, this is the beginning to get close to thinking about how people do respond. In fact, there's a expansion in this tax credit, much like the one in the US, and we're going to use that between people who it's often used, in fact, to say, well, this group had an expansion, their employment has risen. This group didn't face that same incentive, it's pretty flat. You could do a difference of differences and work out the impact. And in fact, you could do that. You could work out the impact, matching all the different characteristics. Say one group got hit by this reform, one group didn't. This is the impact on employment. And that's pretty, to some extent powerful if you believe all the assumptions of the diff approach. But even if they're there, it's still not very useful for tax design because it just says there was this response. It doesn't really tell you exactly what the elasticity was, because for a start it doesn't tell you how the incentive has changed. It just says there was this reform. And so if we want to kind of dig deeper, we have to indeed dig deeper and write down a bit more of a structured model. And that's why the empirical analysis really in all of this work, I'm just giving this as an example, is in two parts. And I think it's always going to be. You try and learn as much as you can from all the reforms that you've seen happen, and look at whether you've got to convince people that on this particular margin, individuals are responding to taxes, and therefore there's a potential for getting something out of tax redesign. It kind of shows you an impact effect, but it's never going to be enough for tax design. It kind of gives you an idea, but you'll see if you want to work out what the how you'd like to change the rate schedule, there's just not going to be enough information there. It's going to be very hard to distinguish intensive from extensive. There's a little bit we can do there, but at different earnings levels, that's going to be hard. So on top of that, we typically think of building some kind of structural model, discrete choice model or some discrete model. It's comprehensive, but of course potentially fragile because it's going to be there's going to be many more assumptions used in building it. And that's, in a summary, is, this is a huge debate between how far you go between these two aspects. But in the end, if you really want to say something about the structure, you really have to have something like two going on. This is true in many aspects of economic policy. You can look at the robustness of certain aspects of a model, but if you want to talk about the whole structure, the design of a tax system, you're going to inevitably have to bring in some economic structure. The second part is the normative analysis, and then what we're going to do is think about bringing the response elasticities we have together with a little bit of theory and think about the design. So just to remind you, I'm not going to spend any time on this, but when you build a structural model of behavior for these kinds of people, you have to make a lot of assumptions, and I've spent a lot of time doing that. I'm not going to spend too much time on it here. But what it then does is give you some elasticities that distinguish the intensive from extensive, say. And that's what we've got here for these lone parents in their weekly working behavior, whether they're in work or not and how many hours they work. And what we found here is that, that extensive elasticities are indeed usually bigger than intensive elasticities. I'm not going to go into all the there's a lot of detail. But it also varies with the age of children. For example, when children are very young with low education groups here, so low wage groups, elasticities are generally relatively low when children are young. And extensive elasticity, participation elasticity is large, but it's not as large as when children are older. So here you begin to see kind of two aspects coming out of this. One is that one aspect is that hours of work or intensive elasticities are generally a little lower than extensive elasticities, certainly when children are around school age. And also these elasticities differ by age of children, for example. It's a very simple point, but it's strong implications, in fact. Do you believe these elasticities? Well, the way you might test that is just seeing how well the model works against in going back and simulating some reforms, and that's what we do. We try and check whether our models make sense. Right. Optimal design. This is the last bit. So what you've kind of looked at key of kind of areas where responses could have happened. You've nailed some behavioral responses. I've gone through this very quickly, but nonetheless, this is the kind of way it works. Now imagine you've got some allocation of money. Suppose we currently allocate R dollars or R pounds to particular groups, say lone parents. Is there a better redesign of the tax system they face? Just a more efficient way of taxing those individuals. And there's in general, when you're thinking about tax design, in fact, the Mirrlees structure has just three components to it. It's got response elasticities, that's the incentive compatibility constraint. How do people respond? It's the empirical distribution of earnings. We know that obviously the distribution of earnings at the point where the tax occurs and the distribution of earnings above is very important in thinking of tax design. And there's welfare weights. And there's a lot of work on this, of course. There's, for example, a kind of very famous now, simple, it's not perfect, but it gives you a kind of feel for it. The formula that I guess originally Peter Diamond had and then Emmanuel Saez developed for his Bates-Clark Prize paper. And you think of this as, how should the taxes increase as I go up the earnings distribution? I is an earning, a kind of a point in the earnings distribution. You're going from I to I plus 1 or I minus 1 to I. You can think of that as a tax schedule if you want. C is just the after-tax income. Don't worry about that too much. What I've signaled here are two things. One is the EI, that's the intensive elasticity. And you always have an inverse elasticity rule coming out of these things. So if responses are generally lower on the intensive elasticity, then taxes can be higher. And if you have a redistributive objective for any given weight, that's always going to go that way. So for any given social welfare weights, elasticities are key. And the number of people in that group, which is going to be the K, that's going to give you a proportion here. And then you look at those above that group, and it's the proportion of people above that group, and also the extensive elasticity here. This is a social welfare weight, and the original Mirrlees formula can be almost written like this. It's a combination of an inverse elasticity rule outweighing a social welfare weight. So the bigger the social welfare weight, the less you want to, the more you want to redistribute to that group. But here what happens, if the extensive elasticity is big enough, that is, there's enough response that if you, at the extensive margin, then that can outweigh the social welfare weight. So even though social welfare weights might be going down as you go up the income distribution. If the extensive elasticity is big enough, it can turn that around. And that's why it's very nice. It's a kind of nice way of seeing how there's a balance between, how the kind of balance of these two things. If you really weight the extensive margin a lot, then you can get a huge weight on the participation tax effect. And so you put a lot of effort into, in the tax system, into tax credit, for example. This would apply to firms, and that you can apply this in many different dimensions. You get a lot of action on the extensive margin, however you define that, maybe hours per week or whatever, depending on how you've read the responses here. I'll come back to how we think about that. And it's the balance of the two. So when I started and said, well, look, you know, you've got to worry about the hours of work variation. You can't really load everything onto the extensive margin. And that's where the trade-off comes. And we put quite a lot of work into that. That approximation has the drawback that it assumes income effects are zero. And that's a pretty strong assumption, actually. And the alternative is to just work with the structural model. I'm not going to spend any time on that. What we find out of this is that pure tax credits, you get some, if you just put the evidence, at least as we saw it together, you get much less tax credits than we actually have in the UK, but you do get some pure tax credits at low earnings for those with young school-age children, and similar arguments for those in pre-retirement ages. And in fact, what you find is a shift of out-of-work support, really, towards families with young children, and then a little bit of tagging. And I can go into a little bit more detail on that. I thought what I'd do, though, just to, for the last 5 minutes, do I still have 5, or is look a little bit about another controversial area, just for fun. It's very controversial in the US, I know, as well, and that's top tax rates. So, of course, you know, what I started with is the kind of bottom of the distribution, and thinking about how you design the welfare system, tax credit, put those together. Now move to the top. The UK does look pretty crazy at the top, and I'm in this system, so I can vouch for that. That this is employer costs in thousands of pounds. So we're talking about 120, so around $180,000 per year taxable income. At that point, and above about $100,000 taxable income, you can see tax rates get relatively high. There are in fact two effective tax systems here. One is the actual tax system as it's called in direct taxes, income tax. There's another tax system on employers, which of course to an economist is just another tax. And if you put the full wedge together, you get this much higher rate, in fact. And that the red line, top red line, is the effective tax rates on incomes by employer costs up the distribution. Of course, at the bottom here, up to around this point, where there's a lot of individuals, you've got the interaction of the welfare system. I'm not looking at that now. I'm moving up here to ask, well, what's going on up here? What should we think of? And suppose, and I guess the idea here is to take an extreme case. This is the kind of Laffer case. You think, well, imagine we just want to maximize the revenue collected. This is a kind of question that people often ask. What would be? Are we kind of past the Laffer point? What should be the top tax rate on? What's the kind of maximum top tax rate you could think of on the top bracket? So imagine you've just got a tax system that has a top bracket, perhaps on the top 1%, and that's going to be what I'm going to look at, because that's exactly what we look at in the UK. What should it be? If you take that formula, that idea that I just looked at, the kind of diamond-sized one, and just apply it to the top tax rate, where you effectively set the welfare weight to 0. So you say, I don't care too much about the welfare. I'm not thinking about that at that point. All I want to do really is think of a top tax rate that gives me the largest revenue. So that's obviously going to be larger than the one you'd like to set, but it's a tax. It's going to depend on two things. It's kind of interesting, exactly as the previous formula did. But now we're not worried about the extensive margin at all, at least on employment. I've got another formula that looks at whether you reside in the country, you're part of the jurisdiction or not. So kind of migration extensive margin if you want. But look at it, this here, it's kind of interesting. You get elasticity coming in, so the optimal tax rate will depend on two things. There's only three things it usually does depend on: social welfare weights, response elasticity, and the distribution of earners. And of course, we've set the welfare weight to 0, just to give kind of this simple case. And then it just depends on the taxable income elasticity, how tax revenue responds to change the tax rate. That's why it's such a key parameter. And the distribution of earners in the top bracket. If the distribution has a Pareto tail, then it just depends on the Pareto parameter. And just to give you a little bit on that, this is the Pareto distribution, the red line, and this is the actual income distribution written as a probability density on a log scale, because that will give you the Pareto tail parameter. And you can see the Pareto tail does an extremely good job of matching the data there. So what we've done here is taken the number here, which is for the Pareto parameter of about 1.67, and then looked at what the top tax rate should be. But now it gets pretty controversial. Because what is the elasticity of earnings at the top? We've got a lot of evidence, in my view, on how labour supply and earnings and employment react at the bottom of the distribution. We have much less evidence at the top. And the kind of evidence that you end up using is very, very weak, because there are very few changes in tax rates at the top of the distribution. For example, in the UK, here's the kind of picture. I'll kind of end on this because it shows you, this is the top tax rate of the top 1% marginal tax rate right back to the 60s, because in the end, you're just doing a very simple time series. You'll try and choose some control group, and I'll show you how we did that. But take the top 1%, this is the tax rate falling during the 80s, then stabilizing at 40% right along here. And this is the share of income, taxable income for that group. And the elasticity obviously relates the two together. And if you just do a simple difference of that full time series, so this is exactly what people have done over the years using these revenue figures, then you get a number about 0.7 for that elasticity, which is quite large. It's not unusually large. The Feldstein original numbers were over 1, but 0.7 is relatively large relative to what you find in the modern literature. If it was 0.7, you put it in that formula, then the top tax rate, the revenue maximizing top tax rate would fall right down to about 30% or less, in fact. But in fact, if you realize that, of course, when income shares are rising, that's probably for lots of other reasons, and you start building a little bit more structure into the earnings distribution. A simple way to do that would just be compare it with the group just below, or another group, some kind of differences, and then you get a number much smaller. And this is in fact the number that but you can see it's still quite fragile. It's relatively small. It's relatively imprecise, mainly because we just don't have much variation in tax rates at that level. If you put those in, which is what I did there, then in that number, then interestingly, you get a revenue maximizing top tax rate of about 56%, which was the tax rate we had in the UK, in fact, until it got raised by about 10%, from 40 to 50. And interestingly, it's just been dropped back to 45. Of course, you can see from that standard error that you have to be a little imprecise there. But it was kind of interesting that the choice of this was straight out of the review. You can go and read the Treasury document. This is always very worrying. They take these figures. One interesting thing, there's a fairly big study of top tax rate effects, if you want to put any reliance on that, by Raj Chetty, for example, where his preferred number comes out to be 0.44, so at least that's close. And of course, subsequently, we've now seen the revenue impact of the change in the UK, and if you work out the elasticity, it comes out to about like this. So this would be a kind of interesting thing. Okay, so what do we end up with then? If you kind of put this together, you get if you go back to where I started here, you put the thing together, you get that some of those effective tax rates at the bottom of the distribution just look too large, at least for some groups. You might want to target some. You might want to allow them to be relatively high for some, for those with lower elasticities. But where the elasticities are really important, you really would like means testing to be less aggressive. And there we're looking at tagging by youngest child age and pre-retirement ages. They're all kind of controversial things, but they can give quite a big efficiency gain if you work them through. The other thing was the complexity side. By the way, I'm putting these up because I'm going to argue we've had some success. So the UK tax system incredibly has followed the first three things almost exactly. Now the tax system is the tax credit system is designed to encourage work just around school age children, just like this, and around pre-retirement ages. Right this month, there's a new integrated benefit which takes all the benefits and puts them together in one integrated form. So there's not a complexity of lots of benefits. It's called universal credit, but it comes from this idea of integrating. And then at the top, our argument there is that, of course, the elasticity isn't one number. It's not a given constant. It depends on the tax base. And really there you want to think about redesigning the tax base rather than before you think about increasing the top tax rate. And it's the obvious point. If you increase the top tax rate on earned income and people can change the way they source their earned income, say through capital gains, or other types of remuneration, then you get income shifting, and that's why the elasticity stays relatively high. And it's really a tax-based problem rather than a tax rate problem. And I'm going to finish there. So I did have a little bit on savings, but I'm not going to spend any time in there. But the idea really was to kind of think about how you might build a picture of where taxes might matter through to the way you might then bring them into the design problem, and hopefully then have some effect on policy design. Sorry, that was a bit of a rush through, but there you go. Thank you.